Hi, Tony Jacobs here from Geneva Financial. I hope you and your loved ones are safe and well. With COVID-19 now classified as a worldwide pandemic, economies have come to a standstill and financial markets have been turned upside down. I wanted to take a moment to review recent economic history as it applies to mortgage rates and your refinance loan transaction. In late February, in response to the rapid spread of COVID-19, investors began rebalancing their portfolios towards less risky assets like treasuries, bonds, and mortgage-backed securities. At that time, the Federal Reserve Board reduced the funds rate on concerns of looming economic impact. The federal funds rate is the overnight borrowing rate that banks lend each other in order to cover depositor withdrawals and other obligations. The fund rate does not directly impact mortgage interest rates, but does have a trickle-down effect. In this particular instance, it prompted mortgage rates to drop slightly. I reached out to you when this occurred, and nationally, many people applied for refinancing. Within a week, in early March, and in order to stave off risk of a long-term recession, the Federal Reserve Board reduced the funds rate an additional 0.5%, reducing the funds rate to nearly zero. This additional Fed rate decrease prompted the mortgage rates enough downward to historic lows, at least for a day. This caused a tsunami of refinance applications. The increased demand for refinance loans was higher than the supply of mortgage capacity of lenders and banks. And just like toilet paper disappearing from Costco, Fred Meyer, or Winco shelves due to high demand, low mortgage rates disappeared almost overnight, as banks and lenders artificially raised interest rates to slow applications. While banks and lenders funded billions of dollars in mortgages to sell as mortgage-backed securities, others also rapidly sold these assets to raise capital, which caused the secondary markets to be flooded. This oversupply of mortgage-backed securities meant buyers were not purchasing assets as quickly as the market, which then sent the prices of mortgage-backed security coupons plunging. This rapid drop in mortgage-backed security value, combined with an overwhelming and historic amount of refinance applications, caused mortgage rates to spike between 1% and 2%. Meanwhile, many major news outlets continue to erroneously report that rates were 0%, failing to mention that this didn't apply to mortgage rates, which had actually increased. Then, in near mid-March, the stock market drastically dropped and concerned investors put their assets into safe cash investments, such as precious metals, rather than the bonds, treasuries, and mortgage-backed securities which investors usually favored when these stock market conditions occurred. In turn, this created decreased value and increased liquidity issues for mortgage-backed securities. As social distancing orders were placed, businesses were forced to lay off millions of workers. Analysts began to realize that homeowners without jobs may not be able to make mortgage payments. This increased major economic worries. This also caused mortgage servicers to panic. The mortgage servicer is the bank or the entity to whom you make your monthly mortgage payment. You make the payment to the mortgage servicer. They then set aside the escrow funds in order to pay your property tax and your homeowner's insurance when they come due. They also set aside a small fee for themselves before forwarding a majority of your monthly mortgage payment to the mortgage-backed security investor. The reason mortgage servicers were concerned is that they typically need to service a loan between 3 and 4 years in order just to break even. An abundance of refinance activity creates incredible financial stress and losses for mortgage servicers. The potential for these early payoff losses devalued mortgage servicing. This is one reason why it's so very important for you to continue to make your current mortgage payment as long as possible. One of the primary issues here is that mortgage rates are priced on several factors, including the value of both mortgage-backed securities and mortgage servicing rights. High refinancing activity caused an unprecedented drop in these values and the subsequent rapid increase in mortgage rates. Simply, this combined market volatility, the factors of reduced liquidity, decreased mortgage-backed security value, decreased mortgage servicing values, and historic refinance applications are all current issues driving up mortgage interest rates. I hope this information was helpful to you to understand what's going on with a portion of our economy as it applies to your current loan transaction. I truly and greatly appreciate your continued trust and patience as we move forward in the refinance process, especially as all indicators such as a super low Federal Reserve Board funds rate, the purchase of billions, hundreds of billions of dollars of mortgage-backed securities by the Federal Reserve Board, a significantly low 10-year Treasury bill, and the possibility of a recession all point to historic and sustained low interest rates in the very near future. Should you have any questions, please reach out to me, and I sincerely hope you and your loved ones are well. Please stay safe.